Welcome to The Riff, where writer and investor Bern Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in.
Well, Bern, I actually want to start with something that is interesting relative to what we talk about and relative to what I'm up to at Turpentine, which is Hunter Book, right?
Yeah.
The hedge fund slash media company. Why don't you unpack why you think that's interesting?
Yeah, so the Hunter Book model, in brief, is that they have there are a lot of ways to monetize news. You can sell subscriptions, you can sell ads, you can find a really rich donor who likes the idea of supporting a particular kind of news. And then one option is you can trade on it. And like this has happened for a long time in both legal and illegal ways. So the legal version of this is just like people who invest like to talk about stocks. They like to talk about things that they own or things that they're short. Sometimes they formalize this and they will, take a big position and then do a big presentation to people on why they think their trade is right. And that can be really fun. And actually, there are two very different business models for this, and they pretty much cleave to the whether you're long or short the stock. So if you're long a stock and you've bought as much as you want, and you kind of want the rest of the market to recognize this. Like the only downside to you there is if the company's buying back stock, now they have to pay more to buy back the stock. On the other hand, that's because the stock went up. You're happy. So great. And then on the short side, things actually get more complicated because if you're shorting a stock, you have to borrow it. If you're borrowing it, you have to pay your broker. The amount you have to pay your broker depends on how much demand there is to short the stock. So if you publish a short idea, one thing that you're doing is ideally moving the stock price in the right direction. But the other thing you're doing is you're actually making it more expensive to hold that position because now other people, like if your thesis sounds good, other people are going to be borrowing the stock and shorting it too. Now you're paying more to borrow. You can mitigate this, like you can lock in a long-term borrow. You could buy puts. There are options for dealing with this. But what it does tend to mean is that on the short side, the optimal thing to do if you are doing this game is like you come up with a really good thesis, you trade ahead of it, you short the stock, and then like you short the stock ahead of publishing, you publish, and then you cover. Or you do your research, you have clients who get early access, they do the trade, and then they cover after. And if that's disclosed and people understand that that's what's going on, it's totally fine. Like you are trying to draw attention to this thing, but then the risk reward on the trade actually gets a whole lot worse for you after you've published. There are exceptional cases there. Like if you find a company that you think is just a Ponzi scheme or something where they are the only reason that they're alive is that they can continue to borrow money or continue to issue stock, then sometimes publishing that short report actually puts the company either puts it into terminal decline or accelerates the terminal decline. So it becomes the catalyst that actually causes the company to unwind. There was a fun example of this years ago where I think the company was like a Spanish telecom called Let's Gowex or something like that. And a short seller put out a report where there was just really damning evidence that the company's revenue was almost entirely fake. And the CEO pretty much got on a plane, tried to flee the country or something like that. And then by the next day, the stock had been next trading day, the stock was completely wiped out. It was like down 98% or something crazy like that. So like sometimes that works really well. So the Hunter Book model is basically that. But what Hunter Book is doing is they're assembling stuff based on publicly available information. And they're doing this for kind of a regulatory reason, which is if you are, and this is something that a fair number of short sellers do, is like they will do a lot of interviews with former employees and they will try to talk to people in the industry and find out, like if a company claims that it's growing and taking market share and you talk to a bunch of people in the industry and nobody's ever heard of them, well, maybe that revenue is fake. Or you talk to a bunch of their customers and you say like this company, and they all tell you like the company has amazing salespeople, product does not do what they say. So yes, we signed up, but we're definitely canceling as soon as the contract is over and we want our money back. Like that's also useful information, but it does create this complexity where you are at that point, if you are trading on that information, you're actually trading on your foreknowledge of a future news story from a journalist. And I mentioned that there were more dubious examples of coupling trading with publication of information. So there was an insider trading case in the 1980s where a Wall Street Journal reporter who wrote, he contributed to the Heard on the Street column. He was actually giving people tips on what would be in the column and they were paying him. And that was a case where the legal argument was that the contents of that column actually belonged to the Wall Street Journal and he was basically stealing. It was basically large scale like theft of office supplies. It's just in this case the office supply was what's the draft of tomorrow's Wall Street Journal. Um, so he got in trouble, did some I think did some prison time, and now lectures on corporate ethics, and stuff like that. So like it gets into really really tricky territory. And what Hunter Book is trying to do is they're doing this in this really straightforward way where everything they say, like you can trace it back to some document that you yourself could have found, could have read, and could have traded on, acted on. So it's all public information. Really, what they're doing is they're trying to analyze it better. And I think this stuff is actually pretty cool. So there was this fascinating situation with Mother Jones years ago where they did a months-long investigation of private prisons, and I think they had a reporter who was embedded in a prison. I forget exactly what the nature of the embedding was, but like they had a lot of detail, a lot of horror stories and things. And when they published that story, the private prison stocks all dropped massively. And then Mother Jones's editor went on Twitter and said, like, we spent a lot of money on this story and we got something like $5,000 in new subscriptions. It's just not viable to do investigative journalism. And my thought was like, if you bought puts, you could have paid for like 50 of those stories. Like it's really straightforward. And I think the further corollary to that is if you want more investigative journalism, you want to make it easier for companies to go public so that there is more money in identifying scammy companies because more of them can be shorted. So I think Hunter Brook is doing the Lord's work here. They're doing a good job so far. Like they've explained things about the mortgage industry that I did not understand before they started talking about it, and it will be interesting to see how much money they make, and interesting to see if like constraining themselves in this way means that their allegations are more credible than those of other people who are also trying to publish reports based on, trying to assemble a bunch of data and publish a report that is designed to drive down the stock price. Like that kind of thing, it always sounds dubious if like these shadowy Wall Street people are conspiring to drive down the stock price, and they are, but they're conspiring to drive it down to where it should be. And so they're really like a conspiracy against a separate conspiracy, and that conspiracy is trying to push the stock up beyond where it should be. So once you grant that corporate fraud does exist, you are a conspiracy theorist, and then the question is, are the conspirators on your side better than the conspirators on the other side? And I think in this case, like so far so good.
Yeah, it's really interesting. Just even zooming out, talking about media and investing. Famously, people say that Andreessen Horowitz is a media company that monetizes via investing. But of course, if you're doing venture capital and you're investing in companies, you're not going to be the most objective or neutral source of information. You're not going to speak negatively about the companies that you've invested in. And we've also thought about, hey, we're building this media company. What's the best way to monetize? Is it investing, and thus we would align our media to be supportive of that investing, or is it actually selling to investors such that we're going to be super honest so they can make better investment decisions, and that would align our media in a different way, or some hybrid, but then you have to balance sort of the conflicts there. I'm curious, and if you don't want to bring it up, we can edit this out, but for the diff, how you think about it, like in terms of investing.
Yeah, so I try to be very aware of conflicts of interest, but I'm a big believer in confluences of interest. So my view is like not only is it fine to say good things about companies you invest in, but like an ideal life is having a portfolio of companies you actually genuinely admire, where you think these are companies that do good for the world and are also fundamentally good businesses. Like they would be a good investment even if they had no real effect on the outside world, but that they are actually doing good things. And then so if you can both promote those companies and also profit from the fact that they're succeeding, like that seems great. It's you get to, if you're an independent journalist, you can choose what to write about it. I guess I shouldn't call myself a journalist. I always try to enforce some separation. If you're an independent media thing, you can choose what you want to write about. If I decide tomorrow that the Diff is actually a cooking blog, the Diff is a cooking blog. It's entirely my call. And I can align my economic interests such that when I am writing, if I'm promoting companies that I think are actually doing good for the world, and periodically saying, either like I try not to write articles that are just totally slamming some company, but I will. If I think a company is doing something that is either really stupid or just bad for the average person, I will mention it and try to explain why I think that way. Like I think that it's good for people to be able to profit from having correct views about the world, and that ultimately that kind of market discipline is really helpful. You can read a newsletter, look at what the person says and see what their track record is. And, if you do that, you also want to see like, what is the magnitude of the things that they predicted? Because someone who is right 30% of the time, but, the only things they get right are like the date of the next market crash and, which company that's in the top 20 of market cap is actually a gigantic fraud. Like, it doesn't really matter if the other 70% was wrong. Like, you'll do okay reading that person. But the market discipline of having views and also having investments is it's just a really good way to just kind of make sure that you're on the right track. And I think the other nice thing about them having a market is that markets also tell you whether what you said was actually important in addition to being true, and whether or not it was something that was widely understood. And I think there's a version of contrarianness that you can do in non-market environments where you just declare something heterodox when it's not, and then everyone gets to feel really good about being heterodox, and they also get to feel really good about being right. So like the classic genre of this is when you tweet something like, they didn't tell you about this in school, but the United States actually had a civil war and people were fighting within this country. Like, no one told you about this. Like, all of the tweets that are no one said this in school, it's just people who slept through history class. This is all stuff you learned in school. And so like the equivalent to that would be, someone saying like, I think Meta's a really good buy at 50. Well, if you find someone to sell you shares of Meta at 50, good job. But it was actually not an especially contrarian view. So when you are actually trading based on your beliefs and you're writing about those beliefs, the writing gives you this sort of it gives you one real world test of those beliefs, which is someone can write back and say you're totally wrong, and that happens fairly often. But also, if you say X is going to happen, and you also say, hey, disclosure, I'm long this stock because I think X is going to happen, it's going to be good for this company, and then X happens, and by the time X happens, the stock is actually down 20%. Well, either everyone knew X was going to happen and they were all pricing in like more, X would happen and this other good thing would happen. Or, yeah, you were right, X was going to happen. It just didn't matter. No one cared. And so the price did not move in the direction you expected. So like, I think it's a good way to align incentives. It's a good way to keep your head on straight. And I think it's just a good exercise, as a writer covering topics in business, to ask like, what is the trade? If this is true, it matters to somebody who is choosing how to allocate either money or time. And how would they allocate their time or money differently in a world where this is true? And especially, how would they allocate their money and time differently in a world where this is true and most people do not realize it's true? So I think sometimes the best way to perform that thought experiment is to just do it. And so that's what I try to do.
We'll get back to the conversation in a moment after a word from our sponsors. Over 100 startups launched today. Do you know who they are? If you're not seeing interesting startups, none of your downstream processes matter. How you source deals at the earliest stages could be your most consequential investment. Harmonic is the most complete startup database, finding new companies as soon as they incorporate and tracking them through IPO. You can create a search tailored to your investment thesis. In one search, filter over company data, including venture stage, industry, and geography, founders and operators' backgrounds, and traction metrics like headcount changes, social media audience, and web traffic growth. Importantly, Harmonic instantly surfaces warm connections to help you connect with founders. The results are delivered on Autopilot, wherever you most need them, over Slack, email, or via API, directly into your CRM, integrating seamlessly into your software stack. Learn why Craft, Bedrock, NEA, and hundreds more trust Harmonic's data by visiting harmonic.ai or use the link in the description. Make sure you mention our podcast, Turpentine VC, during your demo. If you don't already subscribe to Turpentine's industry-leading newsletters like our new daily AI newsletter, Emergent Behavior, or Media Empires, you should. But that's not what I'm here to tell you about. The platform we use to power these newsletters is called Beehiiv, and it's excellent. First of all, it was started by the same early team who helped build Morning Brew into a $75 million newsletter business. And they built Beehiiv to offer that same powerful functionality to anyone sending emails. From essayists to business owners, the platform is beautiful, their text editor is intuitive, and they help you scale your audience with custom growth features. Beehiiv has powerful tools to help you monetize your content. You can easily launch paid subscriptions or pursue an advertising model. The Beehiiv platform will even connect you to premium brands to sponsor your newsletter. Not only do we use them, but thousands of the top newsletters in the world also use them, like Milk Road, Blockworks, the Lindy newsletter, and so many more. Beehiiv's founder hooked up Moment of Zen listeners with a sweet deal. Get 20% off for 3 months with code MOZ. Visit beehiiv.com, that's BEEHIIV.com, to get started.
Yeah, one thing also that's interesting, the difference between venture and hedge fund is just the timing of it, because venture investors want to invest in something that's contrarian at the time of their investment so that they get good terms. But
And then
then,
consensus, yeah,
yeah,
once it's
exactly.
ready for IPO or acquisition, yeah. And
Yeah.
I think that is that's one of the things that I think is interesting about just the change in the life cycle of companies, which is partly because venture did really well early in its history, became a very large asset class, and now venture is a large enough asset class that companies have a lot of discretion about when they go public. And the better the company, the more discretion they have. There are some companies out there where they can probably stay private more or less indefinitely, and they can periodically do a tender offer so that employees get some liquidity, but they don't have to spend much time talking to analysts. They can spend time talking to a board of directors, which is going to be better informed about the business, and is like people with more of a direct interest in the outcome. Analysts are great, but I think like for a lot of people, there is more value in talking to the board rather than public market analysts. And I have been one, so it's my people, but it is there are some definite upsides to being a public company, and actually the market discipline is an important piece of upside. That one of the reasons that one of the reasons to think about taking a company public, if you are deeply committed to doing a good job with this company, is you finally get access to short sellers. And private markets, it's been basically impossible to find a short selling market that clears. Like there was an attempt years ago, and it turned out everyone wanted to short WeWork and Theranos, and they were all right. No one wanted to buy WeWork or Theranos. The price for both of those companies was set by the most hyper optimistic investor. And by the time it was obvious that they were shorts, those investors were not putting any more capital in. So you just didn't have anyone to take the other side of the trade. So when a company can be shorted, you are going to get like the most cleanly articulated thesis for why your business is a bad idea. And being able to look at what the best work short sellers can do and to say, okay, here's why they're misguided, here's why they're wrong, and like here's a good point that they made, but we can actually fix it. So thanks, short sellers. Like that is a source of additional information that's useful to firms. But obviously, just from a psychological perspective and a time management perspective, it's usually not the best trade. I like when companies go public. I think I get more information about them. I can invest in them. That's awesome. But I can definitely understand why they wouldn't want to. But because of this, the lag between when a VC first writes that check and when the company goes public is so long, you just can't predict what mass psychology will look like. Like I have no idea what will be trendy in the year 2034. I don't even know how to estimate that. I think the best I could do there would be just looking at whatever scaling laws seem to be at that point where when you throw more inputs into something, you get outputs faster and faster. Like maybe that does tell you roughly what will be trendy that far in the future. On the other hand, a lot of investors are now completely aware of that stuff in the public and private markets, and so you don't really have an edge there. You just have a different way to bet on consensus.
Yeah. I want to segue to somewhat of a related concept that you wrote about, martingale beliefs, betting
Yeah.
strategies that consistently have okay returns, but blow up periodically, and how they apply to not just finance. When you talk about that?
Yeah, so the classic Martingale betting strategy is you take some game where the odds are like almost 50-50, but slightly worse than that. So the house has an edge. And what you do is you bet $1. If you lose it, you bet two. If you lose that, you bet four, and so on. And like you're eventually guaranteed to make $1 or to lose all your money. But in the short term, what happens if you run that strategy and just you walk out of the casino every time you're up $1 is you have a strategy that always makes you a very predictable amount of money at the casino. And every time you have a drawdown, you always come back from behind. So you always end up ahead. And what I think is, it's useful to know that martingale style bets exist, where there are a lot of bets that have a slightly positive payoff that happens almost all the time in this catastrophic downside case. Taleb has written a lot about this, and he's right about it. I think it's become more salient in part because Taleb has really pounded the table on this stuff. But I think the other piece of it, which Taleb also talks about, is just the psychology of if you don't realize you're making these bets and what you think is you've come up with a good strategy and it just cranks out very reliable, predictable returns, and that every time someone questions that strategy, they turn out to be wrong and you get vindicated, that it's actually the mental effect rather than just that downside that becomes really damaging, where you do start after a while, after a long streak of successful martingale bets, maybe you decide that you're going to bet 2 this time, and then maybe next year, next time you start at 4, and so on. So eventually you do bet a large enough proportion of your bankroll that that blow up happens faster. And I think that you can map that martingale idea to some situations that occur at for investors. So one of them is if you are a value investor and you have a very strong view that a given company is undervalued, as the stock goes down, you want to buy more. And from the perspective of value is this platonic thing, and you have figured it out, that is actually optimal. Like, you want to own a bit of the company that's trading at 50 cents on the dollar and a whole lot of the company that's trading at 20 cents on the dollar. And then the problem is, like, if you are a good Bayesian, at some point you say, like, if I'm buying this stock because it's cheap and it keeps getting cheaper, maybe there is someone who understands something about this that I don't understand. Or, the more folksy way to talk about this is, if you're so smart, why aren't you rich? Like, why isn't the stock going up? And it's always been tricky for value investors to talk about this, because they have to say, like, the market is irrational. Sometimes stocks go way down and they trade below where they should. And then the question is, like, why do they go back up? If they're priced irrationally, why do they ever get priced rationally? Ben Graham, the father of value investing, was actually called to testify before Congress in the 1950s, and he is asked about this. And his answer is, I think his exact words were something like, "That's one of the mysteries of our business." I think now we actually have better answers, which are things like the company will get taken out by private equity, or the company will do a big buyback, or if the company's really overpriced, it will do a large secondary. So there are real world answers for why value snaps back. But in the event that you are a value investor and that is what you do, and you are very dogmatic about your view on the value of a given stock, and you're not necessarily right, it's just guaranteed to be the case that if you are not necessarily right, and you're always buying more as the stock price declines, as that discount goes up, that your portfolio is overwhelmingly weighted to the companies that you know the least about, and they're all going to zero. And there's a fun interview. I forget where this shows up. It might be in the book Hedge Hunting, with where Jim Chanos is talking about Eastman Kodak. And I think what he says is something like, I shorted it at 70 and it traded at 4 times earnings, and I was shorting it at 7 and it was trading at 4 times earnings, and that it was basically trading at 4 times earnings until it stopped making money, and then it never made money again. So people do run into those value traps. And so I think that, like, the difference between value as just a very, very sensible way to think about investing and about allocating your capital versus value as a martingale bet, it does come down to having some level of humility and saying, like, you are trying to find a gap between market value and intrinsic value, but also there is a chance that you're wrong. And the bigger the gap is, the more confidence you need to have that you are actually correct about this. And actually, a lot of money in for the multi-manager, very short-term oriented funds. Like, a lot of what they're doing is, instead of trying to find the rare companies that actually trade at 20 or 30 cents on the dollar, they're trying to find the case where the company trades at 98 cents on the dollar, and we have a very clear reason it will get to 100 cents on the dollar in the next 2 weeks. So that is still, in some sense, value investing. Obviously, they're taking other things into account other than pure valuation, but they are trying to find these valuation gaps. But because the gaps are fairly small, they're plausible, and because those funds will tend to look for an event path between where the price is now and how it gets to intrinsic value, because of that, there's a lot more discipline around knowing very, very quickly that you were right or that you were wrong. So that's one piece of the Martingale thesis. And then there's something similar with market making, which I will not get into all the mechanics of this, but basically, if you are a naive market maker, so you are if the stock price is bouncing around between two values, you offer to buy a little bit higher and sell a little bit lower. Yeah, you do tend to get the trade. Like, people who are trading and are price insensitive will trade with you, and most of the time that works out great. But occasionally it means that you are always the high bidder when there's a huge seller, and either that seller is well informed about what's going on fundamentally with this asset, or even that seller is just well informed about the fact that they have a lot to sell and they're going to keep selling until they're done. But if if you are always taking the other side of that trade, then it always ends up being the case that your largest position in your portfolio is always the thing that is moving against you the fastest, and you tend to get wiped out pretty fast there. And then the last piece of Martingale beliefs, or like belief systems with a Martingale style payoff, are contrarians. And contrarians are great. They're great fun. I like them. And they're very, it's like very socially useful to have people who are constantly looking at all of your assumptions and asking what if you're wrong, and then coming up with specific reasons you might be wrong. But the worst thing that happens to contrarians is when they turn to be right, because suddenly they don't get to be disagreeable anymore. But in some cases, contrarianism is like, it's motivated by, you start with first principles and then you derive something that is very different from what everyone else has derived, because most people are not starting from first principles. And that's great. You're very happy that the world has converged on your worldview. But if you are a contrarian because you just like disagreeing with people, then it's really annoying when it turns out that everyone has shifted their views and they now agree with you, because now you have to either find something different to disagree with them about, or you have to set aside this aspect of your personality and just never be contrarian again. And that seems to drive people a little bit crazy sometimes. So like the example I gave in the post was libertarians on social issues have had this amazing string of victories where if you told someone in the early 1990s that gay marriage would be legal, that people running for president as Republicans would be either in support of it, or at least would be like lukewarm, like there's no realistic path to changing it. And then, on drug legalization, that went from like totally, like drug sentences were getting stricter in the 90s to, some drugs are getting legalized or at least decriminalized, and there's kind of a patchwork at the state level. And then there are clinical trials of ketamine and psychedelics for depression. So like there has been this crazy string of victories for libertarians on those issues. And there's a set of them who are just pretty much, they were libertarians X number of years ago, and now they are a member of some major party because now the major party agrees with the particular libertarian points that they had in mind, or they are now as fringe as someone who was advocating legal pot and gay marriage in the early 90s. It's just they are fringe with respect to 2024 beliefs. So and I think, I guess in that case, like, they're still doing something of social utility. Like, it's useful for people to explore these boundaries of the Overton window and ask why this is beyond the range of acceptable discourse and this thing is not, and to push and tug on those things. But maybe they are just happy being in a vocal and determined minority. But it also does mean that if you are a contrarian and you win, you suddenly have to find some new object level cause to identify yourself with, or you have to drop your meta attitude of being a contrarian.
Yeah. I want to segue to make sure we cover all of our topics today. I want to segue to something you wrote about, usage-based lock-in for AI. Why don't you talk about that?
Yeah. So I was interested to see that OpenAI is now ChatGPT will remember things across conversations. And I think this is, at one level, this is just a natural feature to have, that if you're doing lots of little one-off chats with ChatGPT and, every so often you have a JavaScript question or something, like, it can be useful for ChatGPT to remember what kind of app you're building, what its purpose is, what it will run on, etc. And so that is kind of nice. But what it also means is that now, if there is a slightly better version of Claude than what you're using in ChatGPT, now that version of Claude it's smarter, but it doesn't have all the context that your previous model had. And so I do sort of wonder what this says about the anticipated pace of AI improvements, and whether or not they might be topping out or slowing down for a bit. It could just be like, this is a useful feature to have, and at any pace you'd eventually have added it. But it makes more sense in a world where the pace of improvement is slowing, or where OpenAI just doesn't see a path to investing a reasonable amount of money in the next great model. And we'll see. Like, it's that's hard to argue if you're just looking at the performance of models over time. Like, they are still improving, but they are definitely, the expense of training them has definitely scaled too. And so we'll have to see where that goes. But what that also tells you is that when you have a new technology, there can be a point where it is perfected in some limited sense, or it's very close to perfect in some limited sense. So we've figured out the fundamentals, we know how this works, we know it can change a lot of things, and then there's this long deployment period where you're figuring out all the contexts in which you want to use it, and you're also figuring out all the different ways to do things you've been doing before, given the availability of this new thing. So there are a lot of tasks. If you are if you're researching a company, there are a lot of cases where you could think to yourself, if I had time to read 2,000 pages of legal documents, I would have a really good understanding of whether or not this business will actually be legal. And in some cases, that just means, okay, pass. But if you have an LLM with a very large context window, or you are patiently feeding in documents and getting summaries and then summarizing your summaries and so on, then it is at least plausible to get some level of confidence that these documents do or do not say a particular thing without personally reading all of them. And that just changes the nature of which problems are worth going after and which ones are not. And then there's other stuff within organizations that I think being able, like having this very large surface area of data does allow you to just access things much faster than you otherwise would. And so that sort of changes, I think it ultimately changes corporate org charts, and it also changes the behavior of people who work within large organizations, that there's now a larger premium on writing down exactly what it is that you do, having well-maintained, up-to-date wikis, and documenting your code well, all that stuff, because now all of that is feedstock for your local AI tools that can ingest all of it and give everyone in the company broader context. And then there's a next order effect from that, which is now it gets harder to hide. Like, if what you're doing doesn't actually make sense and you only figure that out because you wrote some documentation on what you're doing and why, and realized through the process of writing it that this is actually, like, the why doesn't make sense, or the what isn't going to work, it's a good check on on your own plans to sometimes just try to articulate them. So I think AI is going to be this nice truth serum that gets deployed throughout large organizations and basically forces people to better articulate what purpose they serve within the company. And then, once they've done that, it's just a lot easier for everyone else in the company to get more context, and it makes the entire organization more transparent. But it does change the nature of people's jobs. Like, there are just going to be a lot more people who, even though it doesn't say that on their business card or on their LinkedIn, but they are like part-time bloggers with a very narrow audience of the other people at their company, and also lots and lots of GPUs.
Yeah. That's funny. You also wrote about the Costco model and how we can apply it to other businesses. Why don't you talk about that?
Yeah. So Costco is fun. I think every like growth/value investor likes to, has the same epiphany about Costco, that they buy real estate and turn it into recurring revenue, and that even though they are, I think it's approaching, it's less than 1% of GDP, but it's like approaching 1% of GDP passes through Costco in the U.S. So it's like a crazy huge company. But actually, that whole thing where they sell goods to people, to shoppers, is not it's not core to it's not where they actually make their money. They run that part at roughly break even, and then they monetize the subscription. So okay, a lot of people understand this, and a lot of people understand that there is this wonderful benefit to that, which is that Costco gets really good data on what people want, what offers they respond to. Also, because you have a membership card, they have information about things like your address, your phone number. So what they can do from that is they can map out a given city and look at, okay, there's this neighborhood or there's this area of the city has a population that is almost large enough to support a Costco, but look at this. On a per capita basis, people are twice as likely as we would expect to sign up for Costco memberships, and they are driving, an hour and a half out of their way, once or twice a month, to do a big Costco shopping run. So if we plop a Costco down in this neighborhood, one, we already have an existing cohort of customers, and two, we think that this neighborhood has a higher propensity to spend at Costco, so it's probably where our next store should go. So you have this compounding data advantage. A lot of it's kind of localized, but there's also broader data that they can get. They have this limited set of products that they buy, and one thing they could look at is, if you bought this product, did you actually buy another instance of it in a reasonable time frame or not? So they can test those kinds of things at massive scale and make sure that that limited set of SKUs is exactly the set of SKUs that a Costco customer would want. And that general model, part of what makes it work really well is that when you're thinking about where to spend your marginal shopping dollar, it's just much easier to spend it at Costco because the marginal cost of buying things from Costco is so cheap compared to anywhere else, basically. And so by setting things up that way, they actually encourage maximal usage, so maximum speed amortization of all of their fixed costs over all of this over all this spending. They have really high inventory turnover, so their capital needs are a lot lower than a similar sized retailer would have. Um, but also they keep capturing wallet share over time, even though they're not fully monetizing that, they do get the data that they ultimately monetize through their actual membership revenue. So you can think of that model and apply it to other cases where there is some product that has an associated consumable. And what you would want to do in that case to Costcoify that business model is like the one version of the consumables business. People always talk about Gillette with giving away the razors, making money on the blades. Someone did actually analyze Gillette's early financial statements and their ads and things, and found that that's actually really not true. Like they were making money on both, and it would be really hard to maintain their market share in blades. Anyway, there are businesses like that, like Traeger, the pellet grill company. So their bet was you buy a grill, maybe they don't make much money on the grill, but if you keep grilling, you keep buying their pellets. Their pellets can be high margin. You're locked in because you have a grill that just works with those pellets. You could also think of like a Keurig coffee machine where they do try to make sure that if you're using non-Keurig pods, the machine's not going to actually brew you anything. So like those models do exist, but what the way to Costcoify that model is that for Keurig, for example, you would pay a like flat subscription fee, and then you'd be buying your coffee pods at cost. And it's unclear to me exactly how you'd frame that. Like with Costco, you could say, okay, you got access to Costco, so you could shop at Costco. That's why you pay for the membership. With something like Keurig, paying to access a machine that you actually bought and put in your house is it's a little weird. Like customers really don't like the idea of they bought something, it's in their kitchen, they're looking directly at it, it's plugged in, the light is shining, and it doesn't work because they have to actually pay to unlock it. It feels like it's being held for ransom. But if you can find a way to articulate that, or if you have a more complicated product like some capital good in manufacturing where you want to monetize it by selling inputs into that product, but you could also monetize it through software, I think the software piece gets more interesting. And often for especially those more expensive products, there's potential for accumulating a data moat. So I think that there is going to be that transition in the kinds of businesses that do an initial fixed purchase that is somewhat subsidized by the company, and then this recurring usage-based revenue. I think more of them will switch to there's like a recurring flat membership fee, and then the usage-based stuff is priced at a level that is as close to break even as they can make it, or potentially even slightly money losing. And the idea for Keurig would be like, if you can make it so that it is much, much cheaper to have a Keurig coffee at home than it is to go to Starbucks, you are taking wallet share from Starbucks. You're also depriving them of some of their own data advantage. Now they have a little bit less information on the coffee consumption habits of people in your neighborhood. And Keurig, meanwhile, has more information on those coffee consumption habits. So cutting that marginal cost as much as possible to influence consumer behavior, and then monetizing those loyal consumers at some flat cost. And then ideally, using the data that you get from all of those consumers and from their higher relative consumption means that you have the data you need to keep on expanding the business.
Yeah, that is well articulated. Because we have 6 or so minutes left, I'll rapid fire to the last two. One is the case for GDP-linked bonds.
Yeah. So Sri Lanka went through a financial crisis recently. They are trying to refinance by issuing bonds, or considering this refinancing by issuing bonds that have a payout linked to GDP. There is this debt trap companies can fall into where the amount of interest that creditors demand on a loan to them is so high that there's just not a way they can spend money such that it actually has a return that allows them to pay those bonds. So one way to somewhat avoid that is you say that instead of getting a fixed payback, you actually get a variable payback, such that if they do manage to completely successfully turn around their economy, you, the bondholder, have basically stock in the entire country. And that means that you can accept a lower immediate return, and you can somewhat alleviate their fiscal burden. in exchange for which you get more upside, but only if there's a lot more upside to go around. Now, it's still going to be controversial. Like if this goes through and if Sri Lanka's economy turns around, there are going to be stories about how Sri Lanka transferred X% of their GDP to evil hedge funds, and the story is not also going to say, well, they got much more than X% of their GDP at a much worse time in their existence from those very same hedge funds, or at least from people who ultimately sold their bonds to hedge funds. But yeah, having when any borrower is sufficiently distressed, the usual way to reorganize things is that the most junior creditors have their credit swapped for equity. You can't usually do that with a country because they usually don't issue GDP-linked bonds, although there are really old precedents for this. So in the Renaissance, the city-state of Genoa actually issued bonds whose interest was linked to their tax receipts. So pretty much before you could actually buy stock in companies. I think the German mining companies that issued the earliest shares that I know of, they were a little bit later than that. So like before you could buy stock in companies, you could buy stock in independent countries. So in some ways, it is just a return to a very old tradition of financial engineering in order to align incentives between governments that want to spend money and investors who are okay with government spending money but really want to see their money back later on.
That's a good overview. You also wrote about vertical software companies acquiring operating companies in their vertical. Why are they doing that?
Yeah. So there's I think one. So I think there are two pieces to this. One is CAC. So in some businesses, especially very old and very fragmented businesses, it's just incredibly expensive to acquire new customers. So you have an amazing product, your product provides this 10% revenue lift, very little cost lift. And so it's basically free money for your customers, but your customers don't care. They don't answer your emails because they don't use email. They don't answer your phone calls. They don't like hearing from salespeople, etc. So sometimes the easiest way to land that customer is you send them a nice letter saying, we wish to buy your business for a very large sum of money. Please tell your board of directors. And these kinds of deals have actually happened. So there's a company called Metropolis Technologies. They do basically image recognition for parking garages. So like basically parking garage software that makes it easier to just drive in, drive out, get billed automatically, I believe. They actually raised a bunch of money and just bought a parking garage operator. The company that is trying to take WeWork out of bankruptcy is a company that does software for managing commercial real estate. And so one piece of that is just, it is a way to land a very, very large customer at what might be a reasonably competitive cost of customer acquisition. But the other piece is, if you have a really, really good software product and you think it adds a lot of value for your customers, you ideally want to capture as much of that value as you can. Like it was your product that made the customer all that extra money, so you want to charge enough to recoup that, to capture that benefit. But if you do actually charge literally what the product is worth, nobody buys it because they're actually not sure what it's worth. So Google, even if Google is worth like $50K a year to me or something like that, Google would not have very many customers and would not be a very big company if it were a product you had to pay $50,000 a year to use. And also, I would probably just switch to Bing or DuckDuckGo. But if you acquire the customer and you acquire them with the business valued based on what those businesses are typically worth, and then you can materially improve the profitability of that business, then you capture all of that upside. Now, it's a much, that is just increasing the value by deploying your software, like that is it's a big lift, and there is plenty of enterprise software that just gets bought but does not actually get used, and it's perennially difficult to integrate complicated software products with large established businesses. But if you can pull it off, that is the way to actually capture most of that value. And then once you've done that once, you have a model that you can keep applying. So once you've acquired one chain of parking garages and you borrowed some money to do it, you can show lenders the next time you want to acquire one, like, here's what the interest coverage is now, but here's what it's going to look like in 2 years based on what we just accomplished with the last one. I think the last piece is like, it is a way to take your business, it's a way to take a software product more seriously. People write software, some of it's for fun, and a lot of it is to change the way that people do certain things. And if you really believe that you can change the way people do certain things, that you understand their problems really, really well, such that you can actually solve their problems, one way to really demonstrate that, and also to figure out what the next feature should be, is become a user of your software. So I think that is there's always there's always this continuum between tech and non-tech. Like arguably Walmart was one of the great tech stocks of of the 70s and 80s, because they were doing things like incorporating barcodes really early on. They were using computers before most of their competitors, even larger competitors, were. And they were just a very data-driven organization, which meant that they had a much better view of what their inventory was, what was selling, what they, how customer elasticity varied across different kinds of products and different locations and different times and things. Like they had this huge information advantage. And then the way that they actually took advantage of that was building more Walmarts. That was the cheapest way for them to sell and deploy, Walmart, the software product, was build the Walmart, the actual superstore. So I think if it worked for Sam Walton, and he was the richest person in the U.S., I believe richest person in the U.S. when he died, at various points, was a very, very wealthy man. And there are just a whole lot of Waltons who are still in the upper reaches of the Force 400. Like if it worked for Sam, it will probably work in other contexts too. So I'm excited to see how that develops.
It's interesting. We've seen something similar around a conversation around media companies as ways to get negative CAC. And we saw companies like HubSpot acquire The Hustle. And there was this idea of, oh, hey, are SaaS companies going to acquire all these media companies, or will they try to build those media companies internally? Or, Robinhood, or just one. Or will media companies be able to build these tech companies? And which one is easier for the other to create is an interesting question.
Yeah, that is an interesting one. I could I think hold a fun just debate within my head on which of those do you want to bet on. Like, do you want to bet that the New York Times, in addition to doing Wirecutter, they open their own fulfillment centers, so not only can they sell you this product, but they're actually shipping it to you. They're not just taking an affiliate fee. That's not really core to their business. On the other hand, the New York Times, at least historically, was in the business of same-day delivery for millions of individual products, newspapers. So maybe if things had gone in a slightly different order, they could have actually done that and could have used their existing distribution network. Now it makes a lot less sense. I think fewer people are reading a physical copy of the New York Times these days. So and at one level, you could say that media companies, it is their business. Like if they're writing about a particular industry, it's kind of their business to understand that industry. But do they actually understand it? Maybe a media company is more entertaining if they persistently do not understand their business. This sometimes seems to be a huge source of potential energy in tech media, is that a lot of it is written by people who do not like tech companies. In part, there's this selection effect where you write about tech companies. If you do a really good job and you're always good at finding promising companies really, really early, eventually you become a VC. And so because of that, the people who either don't like to do that or aren't good at that don't actually have that particular exit path. So there tends to be this evaporative cooling effect where they become more predominant in the industry.
Yeah. Well, on guilty as charged there in some ways. On that note, let's wrap this episode. Bern, as always, great going through your pieces, and until next week.
Until next week. Later.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Bern's excellent newsletter, The Diff, if you haven't already. Hey everyone, Eric here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at ericaturpentine.co. That's ERIK at turpentine.co, and let's partner together.